Financial markets are stabilizing since a couple of weeks, and this is due to two main factors. One is a stabilization in the oil price, and secondly, stabilization in the Chinese currency and Chinese anxiety about economic growth. Concerning the oil price, we have seen a recovery to $37 a barrel. This is due to a deal between Russia and Saudi Arabia and other OPEC countries to freeze the oil production around the level of production of January of this year. We believe that the oil price will continue to rise, will go to 45-55 range. This is a rebalancing of this oversupply market. This rebalancing is underway. There is one big question about the Iranian production, the level of production, and the timing of the coming back of the Iranian production on the global market. Secondly, we have seen the Chinese currency stabilizing. Authorities did manage better their communication to the markets, and we had a couple of macroeconomic news also helping the sentiment. So the fears about a hard landing in China are less common currently. Overall, stabilization in the oil price, stabilization of the Chinese currency, and so the financial markets volatility came down. We have been revising down our forecast in terms of GDP growth for mature economies. We are talking about a small downward revision. We expect global growth to be around 3% this year and 3.3% next year. Overall, mature economies continue to be supported by strong domestic demand. In emerging markets, in emerging economies, the adjustment is more important, especially in commodity exporting countries where the decline in prices has a strong impact. Inflation also is revised down because of the decline in oil prices, and overall, because of the decline in growth and inflation, we are revising down also our bond forecast. We expect Treasury to be at 2.2% in 12 months, and we expect the bond to be at 0.5% in 12 months. Because of the slower growth environment and lower inflation, we expect central banks to adjust their policies also. First, the Fed is not going to tighten in the near future. We expect a wait-and-see policy, at least for a couple of quarters. We expect only one move by the Fed by 25 bips this year. Concerning the ECB, we think that next week, so the 10th of March, the ECB will decide more quantitative easing. There are strong expectations about that, and we will see if they lower the negative rates again, if they increase quantitative easing and the amount of bonds they will back on the market every month. So we had a difficult period of time on the financial markets with this risk-off period. We stick to the view that bond yields are too low currently compared to the real level of inflation. So core inflation rates are still too high compared to the nominal level of interest rates. So we stick to the view that govies will not deliver good returns over the long run, and so we prefer to take risk and to move into equity markets. The current volatility is offering an opportunity to increase positions, especially in continental Europe and Japan. We stick to the view that economic growth will be moderate this year and next year, but will be positive. So the implications for earnings are also very positive. The valuation improved for all equity markets with the current phase of doubt. And again, we use this volatility as an opportunity to increase positions. The reality is not as dark as the sentiment. So this is a key message, and we move clearly toward risky assets. This month, we make only one change in terms of sectorial allocation. We move the listed real estate to an overweight, to a positive stance. We think that the valuation improved with the decline in equity prices, and the general low interest rate environment will continue. That will be positive for real estate over the long run. Thank you for your attention.